Morning, folks. I don't know what it's like where you are, but it's a blustery day here, as Pooh would say to Eeyore in the books of Winnie the Pooh. And I don't know if you can hear this because of the blustery wind, but we're going to be talking about weather and gas shortly. It's interesting in markets in general how people have sort of said the market has corrected about 2 or 3 or 4% on the S&P, a little bit less or more than that on the Nasdaq. Suddenly everyone's bearish on the markets and everyone was bullish about a week and a half ago. And now that we've had a small correction, I don't know what's going on, but I do think that this is probably just a correction when you look at the price action going on and the sort of hesitant and tentative way the market's coming off. And I think this is possibly just a correction. And for the rest of this quarter, we'll probably see continued dollar weakness, even though the dollar's pulled back up a little bit. And we'll probably see stocks begin to rally a bit more, perhaps later towards the end of the month. And then we'll have to see how that affects gold and currencies and the majors against the US dollar. And of course, natural gas and some of the other commodities, which may be actually on their way up because of a weaker dollar, not only because of that, because of various other demand factors that we'll talk about. But we're going to go back and have a look at the video shortly, and I'll speak to you when I'm back in my office a little bit later on. I've got some interesting ideas on natural gas, and we'll talk briefly about the other markets too. In the meantime, I'm going to get my way back home through this blustery breezy day down at the seaside here, and I hope the weather's a bit better where you are, particularly for natural gas traders. I'm hoping that it's a blistering hot day there and that all the air conditioners are being turned on faster than you can say Jack Sparrow. So I'll speak to you soon. Hi folks, let's talk about natural gas. It's very difficult to do this succinctly and accurately without waffle, and to try and communicate through doing a video is actually not as easy as it looks. But I'm going to show you what I've done today for you, and I've got a piece of paper here in my book. This is my special book with all my stuff. Things like supply and demand risks, storage, technicals, and the COT report and all that sort of thing. So I'll put that on the screen right now. Before we start with that, please, if you enjoy this sort of thing, give the video a thumbs up and consider subscribing to the channel and watch right to the end, because there's some interesting insights onto where I think natural gas could go over the next 6 to 12 months as we approach the winter and move forward. So let's have a look at what I've written down here. I'll put that up on the screen right now and just read through it with you. And I've got it divided into sort of 1, 2, 3, 4, 5 areas. And let's start with the top one. That's supply risks. So what might be jeopardizing increasing supply or reducing supply? And we've got the rigs count. We saw that's coming down. That's been down for about 5 or 6 weeks in a row, perhaps more than that now. We've got so that would put a sort of a boost under the price, I suppose, as supply reduces because of reduced number of rigs. Then we've got Russia and the Ukraine situation. That geopolitical risk is not going to go away anytime soon, and it always poses a threat for not only gas and oil, but also for other commodities such as grains that we're seeing already with attacks on ships and so on in the Black Sea and around Odessa. And then the other supply risk is the green movements, people looking to reduce the amount of natural gas used from the supply side rather than from the demand side, which is interesting. You'll see movements such as Just Stop Oil and that sort of thing going on in Europe and the UK, trying to reduce the number of investments or the amount of investment on the supply side, and hoping that that will trickle through into production and demand. Perhaps that's not the right approach, I don't know, but I think those ongoing green movements will have an overall effect on the supply of natural gas. So if you look at the supply risks, they're all kind of bullish for natural gas. Rigs down, we've got Russia, Ukraine, the Black Sea, green movements, etc., all potentially bullish for natural gas. Then we've got the demand risks, and of course, what makes people use natural gas, mostly heating for homes and also in industrial applications, industrial electricity and so on. So we'll have to have a look at that. So we've got weather, and we've got potential summer storms coming along currently. I don't really follow the weather patterns too much, but I've been seeing rumors that there are storms, cyclones, whatever you call them, coming through, particularly in the US, obviously not so much in Europe, but that will have an effect on natural gas. And normally when you see these storms, the demand drops off a bit. And then there are talks of a winter sort of supercell coming along this current winter, Arctic conditions over the US and Europe. That'll be very interesting. I'm not sure how they can predict that so far in advance, but then, that seems to be something that's being looked at. So that will increase demand for natural gas. If we do see this sort of Arctic winter supercell careening across Europe and the US, and then, of course, there's seasonal adjustment for demand as well. And as we move into winter season, particularly in the heat of summer, there's a bit of an increase and then a dip off as we go towards the end of summer into the fall, and then an increase as we approach winter, and then obviously into the middle of winter. Then we've got storage risks, the storage cycle. I'm going to have a look at that quickly. A lot of people place emphasis on what's going on with storage. You'll see it's a very cyclical pattern which repeats almost perfectly year after year after year. We see drawdowns on supply during winter, quite dramatic drawdowns. We see storage amounts begin to increase as we approach summer after the winter ends. Then there's a bit of a drawdown during the summer, in the heat of summer. Nothing nearly like we see in the winter, but still a bit of a drawdown as natural gas is used for electricity for cooling. And then we see storage build up again towards the end of summer. And as we approach fall and then into the winter, we see the biggest drawdowns. That takes place every single year like clockwork, and it's almost identical every year. So I don't think that's really all that important. And then, of course, the technicals on the chart. I happen to think that the charts reflect what's going on in the real world and that the charts are really important. So not only do I look at all the stuff we've just talked about, but I also look at the charts, and then we'll look at support levels. We'll look at what I think now is a new range that we've moved into, a higher range between $2.50 and $3. We've moved out of the $2 to $2.50 range, I think, for now. And we'll have a look at a couple of interesting things on RSI and stochastics. We'll have a look at the moving average, and I want to focus on the weekly chart and potential targets for natural gas as we move out of summer into the fall and into winter, and as we move into these potential Arctic supercells cavorting across Europe and the US this coming winter. And we'll have a look at the candlesticks as well. The final thing I want to look at today is a cot positioning. Now, I'm going to try and do all of this in about 10 minutes, maybe 15. And it's really difficult to put it all together in a sort of coherent and logical manner, which flows beautifully. It's a bit of a trick, a bit of an art. I'm going to try and do that in the next 10 to 12 minutes. So we'll go through all of those. We're going to touch on them very gently. But the most important thing I want to look at is the charts and show you what I've got on my screen and what I'm looking at, not only on the short-term charts or what happened last week, but also the bigger picture. So let's get straight into it. Okay, so let's go through this list. You can refer back to it, and we'll start with the first thing on the list, that's supply risk. And the first thing that we do notice that rigs were down. So we talk about all the things that potentially increase or reduce supply. Obviously, as supply increases, the price is likely to come lower, or there will be pressure on the price, and as supply reduces, the price is likely to go up. It's not a perfect relationship, of course, but it's something similar to that. Let's have a look at what the news is. So I'm on barchart.com, and we're going to have a look at the COT report from here shortly. But just the headline news on here is this: natural gas prices recover as US natural gas rigs decline. And the blurb beneath that is September NYMEX natural gas on Friday closed slightly higher. Natural gas prices Friday recovered from early losses and closed slightly higher. And short covering emerged in natural gas futures on Friday afternoon. And Friday afternoon is when we saw that rally. When we have a look at the charts, you'll see that. So rigs down, and I think it's been a number of weeks in a row, maybe 5 to 10, I can't remember the number, but on the decline generally, the rig count. We've got ongoing potential supply problems with Russia and the Black Sea and Odessa, and bombs and things going off, and pipelines under jeopardy. So all of that's going to remain. And then this green movement I spoke about before. So there's not much to talk about from the supply side, except that the risks are all to the downside: reduced supply, reduced number of rigs, and ongoing geopolitical risk to supply on the supply side. So that's all we really need to say about that. We're trying to look for things that are either bullish or bearish for the price of natural gas. So I think on the supply side, we can quite confidently say that the risk is all to the bull side. In other words, there's ongoing supply risk really, and upward pressure on the prices from that. Demand risks, I really don't know. I think overall though, if you look at natural gas demand, if supply drops and demand keeps steady, I think that's going to put pressure on prices to the upside. We've got some summer storms coming up apparently, which may negatively affect the price. And then we've got this anticipation of the winter supercell Arctic storm thing approaching, or potential for that to occur. I don't know what the story is on that. And then we've got seasonal adjustments and demand. Now we're sort of in the middle of summer right now, but as we go into the fall, this is when storage starts to need to be stocked up. And this is also the time when buying begins to be looked at, and also particularly forward covering for Forex and Forex exchange rates, and people trying to predict Forex rates going forward, as in when purchases are made or when payments have to be made. All of that sort of thing is now coming into focus, which will also put a bit of an upward pressure on prices. So as we approach that winter season. So overall, that's all I want to say on supply and demand. I think the pressure overall is to the upside on prices, when we look at both the supply and the demand scenarios. And then the storage cycle, people often say, well, we talk about storage, how much is in storage? I want to show you this very quickly, and I've taken this from my FX book. This is the natural gas stocks change rate going back to 2013, so this is 20 years. And you can see what happens. These dips here are during the winter periods when there's a drawdown on natural gas stocks. Naturally, that's when the greatest demand occurs, and that's when you get the drawdowns. And then what's interesting is in these summer seasons here, you can see as we go into sort of the spring period, that's around about May, April, May, somewhere around there. That's when we reach peak storage capacity, or storage is full. And then we see a bit of a dip into the summer, and then a bit of a rise as the summer begins to dwindle out as we start approaching winter, and then the big drawdowns occur in winter. Now, this is a very, very predictable pattern. It occurs every single time, year after year after year. You can see it's almost identical. The timing's identical. The levels are almost identical. There are obviously fluctuations which will affect the short-term price of natural gas. This is a very steady picture, and I don't think it's the most important thing to focus on. It will have an effect on the short-term price. This is just a cyclical, seasonal change which occurs every year, more or less the same levels and more or less the same timings. We know it's going to get cold in the winter. We know that the storage levels, the stocks levels are going to drop. We know it's going to get hot in the beginning of summer. We know the weather's going to be moderate during spring and autumn, but in the heat of summer, there will be a bit of a drawdown on stocks, and you see that on these little M-shaped dips every single year. And there will be variations, of course, depending on the temperatures that are reached during those periods of the year. So that's all I want to say on that. And I think the storage cycle this year so far looks pretty normal. If anything, we reached an ever so slightly lower level at the beginning of August this year compared to previous years over the last number of years. Actually, that's a little bit too zoomed in. Let's go to 5 years. And you can see a slightly deeper dip than some of these preceding years compared to, for example, 2020, 2019, 2018. We had quite a drawdown this season, beginning of summer. We know we had some really, really hot temperatures across Europe and across the United States, and that's obviously something to do with that. Right, now that's all that picture. I think if we look at overall and in a very simplistic and basic way, I think we're pretty supportive on the natural gas price as far as supply and demand and storage risks and cycles and seasonal cycles. I think if anything, the risk is to the upside for the price of natural gas. Now let's go and see if that's supported by the technicals on the trading charts. Actually, I want to have a look at the COT report before we go across to the charts. This is the commitment of traders, and we got the last number coming out on the 8th of August. Let's just have a look at this sort of table here, and then I'm going to show you a chart that I put up on Twitter, which I annotated, which you're not going to get on here because I haven't put all the lines and squiggles on here. But I'll show you the one on Twitter, which I've already put all those lines and squiggles to show you sort of what this is pointing out. But if we go through the table, look at what we've got here. This is as of the 8th of August. I want to point this out to you super fast. We've got the commercials, producers, managed money, non-commercials, top dealers, and other reportables. Let's just have a look at the long-short balance, which way these are swinging. And you can see the commercials have increased their long positions and decreased their short positions. So those are generally, I think, people who are producing and selling and that sort of thing, people involved in the business of natural gas. So there you've got the commercials and the producers, the same sort of thing. This is sort of split up on this table. So the producers also increasing their long positions, plus 6,000. Short positions slightly increased, but only 790. Managed money reduced some of the long positions very slightly by 2,900, but reduced the short side by 34,000. So no real increase to the long side, but a dramatic decrease to the short side. So overall, the net result is a swing to the long side, even though not any vigorous buying, no additional long contracts, probably because a lot of these people are holding long contracts already and bag holding those contracts from a pretty long time ago. And these ones may have been hedges, the short side positions that the managed money is getting rid of, dumping. These are probably hedges to those long positions. They're not willing to add to the long side, but they probably taking the short hedges off. So that's a net swing to the long side. Then we've got non-commercials, pretty balanced really, a bit of each on each side, and other reportables, swap dealers. The swap dealers are really interesting. Now, as far as I understand it, these are kind of hedges. These are people that are market makers, people that have an interest in being in the opposite direction to the market. And you can see they've reduced the long side by a small amount and increased the short side by a small amount. So in other words, a swing to the short side for the swap dealers, the hedgers, the market makers, not much, but fairly significant if you compare that to what the managed money and the commercials are doing a definite swing to the long side on the people on the left hand of this table, but a slight swing to the short side by the hedges and the market makers and the swap dealers. So overall, I would say that people are positioning towards the long side on natural gas. We'll have a look at the chart that I put up on Twitter. I'll try and show you kind of what it looks like. So on barchart.com, you can take that information that we had a look on the table and put it onto a chart. I'm not going to do that now because it's just going to waste time, but I've taken that information I've just read out from the table, put it onto the chart for you. And this is the hedges I talked about, the hedges, the market makers, the dealers, starting to reduce their long side exposure, moving slightly short. And the large funds, the traders, the hedge funds and so on, people who are trying to make money out of this product, natural gas, definitely positioning to the long side. In fact, the largest long side position since going back to about here, which is July the 10th, and certainly on July the 10th, and now these are the highest levels or the biggest swing towards the long side from large funds. And the same with the producers and the sellers. Not quite as much. It's this red line, not the yellow one, but you can see this is edging up as well. So the people that are trying to make money out of natural gas are positioning to the long side. The people that are trying to protect their positions, the hedges, the market makers, the swaps, the dealers, are swinging towards the short side, because they have to take the opposite side of the market. So that's that on the COD report. Now let's go across and have a look at the charts. What I want to do first of all is have a look at the natural gas chart on Friday, on the 4-hour chart. Let's just have a look at this. Now on my last video, I said we're looking for this price to pull back into the support level at around about $2.70-ish, which is what happened. And I said we were looking for a spike low, told you not to panic, that this pullback is normal. We came off this high at about $3. That's that swing high. We broke through that gap between $2.90 and $3. Just waiting for these charts to update. I'm going to have to just sit around and watch this. I'll pause the video in between. So we broke through that liquidity gap there, rushed up to $3, just as I thought we might. There was no resistance there. It was like slipping through butter, really. There was nothing to stop it from rushing up to $3, but $3 was certainly always going to be a challenge. We were aiming for the top of this channel. Now, what happened was on Friday, we pulled back. Thursday and Friday, we pulled back down to the support level, and that's where we found support. Look at what happened. We saw this big move down and then this reversal candle. This is a piercing pattern reversal with a tweezer bottom. It's a very powerful reversal pattern. Please look at my last video. I explained to you exactly what I was looking for, and this is exactly what happened. And that enabled me to add to my long side. I added another position on this pullback. Now I'm long 3/4 of my desired position size at around about $2.60. It's actually $2.68. My average position size. Now carried the position from $2.51, and I've now added on a little bit more as we've dipped down into these levels. So I have a 3/4 size position at $2.70. My strategy is to stop and reverse or hedge, depending on how you trade. My trade idea on this is to hedge, and my hedge position is at $2.43. $2.43 is when I know that this idea will be wrong, and that we've now fallen back out of this new range that we've formed back into the $2 to $2.50 range. We've moved into a new range now, and that's the $2.50 to $3 range. And I think as long as the evidence shows that we're still there and we're stuck in that range, we should not expect to move back down into the $2 to $2.50 range. You can see it quite clearly on this 4-hour chart, but let's have a look at the weekly chart and the daily charts, because those are more interesting. Actually, I'm going to switch this chart over to daily and keep it on my broker, and then we'll have a look at the weekly chart on the NYMEX Henry Hub price. So here we are on the daily chart, and you can see quite clearly this red line here, this red support line at around about 247, call it 250, separates these two ranges. The lower part of this range between $2 and $2.50 extended for quite a long period, most of this year up until now actually, all the way up until sort of beginning of July. And since then, we've moved up into this $2.50 to $3 range. We have not fallen beneath this level since the beginning of July. We're now halfway through August, so that's 6 weeks or so that we've been trading above $2.50. And the two occasions, actually 3 occasions now, that we tried to break through there, down back through that level, we were rejected quite sharply. This is the daily chart, remember? And we've now formed a triple bottom at that $2.47 level. Actually, I need to clone one more of these little green circles and put it there just to emphasize that we now have a beautiful triple bottom. Not only is it this red support line, but it's also this rising channel line. And that area there where we bought the last time formed a perfect opportunity to buy with another piercing pattern on natural gas. The daily chart candle on Friday was a spike low. It's not a reversal candle on the daily chart. Let me just make that very clear. This is not a reversal candle. This is a dragonfly doji, or a spinning top, or just a doji candle, whatever you want to call it. It's not a reversal candle. We have a lower high and a lower low. It's a hesitation candle. It's not a reversal candle. And in fact, if anything, if we look at Thursday's candle on the day chart, this is a bearish engulfing candle. So on the face of it, this market's actually looking quite bearish. But in the bigger picture, we've actually just fallen back to this really, really important support level, this pink zone where we broke out through that $2.75 to $2.80 level and rushed up through that liquidity gap up to the $3 level. So this is a really important level at around 275, 273, whatever that number is, 274. And ideally, we'd like to hold above there, but we have to allow for dips all the way back down into this channel. I'm not saying we're going to hold here, but when you look at the 4-hour chart, it looks pretty positive. It looks like we've got that reversal pattern that I was looking for. We must allow, however, as we always do, for a move back down to the bottom of this channel and the support line at $2.50. If we break beneath there, remembering it's a really key level. We've made and created a new range between $2.50 and $3. We've got a triple bottom here. That's why I've drawn these 3 circles in next to each other. Actually, the timing between each one of these bottoms is quite similar too. And then the strong move up and a pullback. I think this is just a pullback and that we're going to be moving higher on natural gas. We've had a look at all of the reasons in this book, in my notes, why I think natural gas is supported. While I'm talking about it, and I'm going to flash it up on the screen, I'm going to recommend that you go over to Energy Rogue. And if you're interested in finding out what the fundamentals are on the ground, so to speak, those are really good guys involved in the oil and gas industry for a very long time. And what they're saying also adds to my conviction that overall we've got a bullish market. And if you're interested in their analyses and their insights, you can go across there and sign up. There's a special link underneath this video where you can get a discount at Energy Rogue. I don't get anything for promoting them. This is not a sponsorship deal. I use them myself. They're friends of mine, and I just think that you benefit from it. So before you start saying, I said I don't take sponsorships, I want to make it very clear I'm not sponsored by Energy Rogue at all in any way. I get no financial compensation from them. So we looked at all the factors that seem to be supportive of the price of natural gas moving forward, and the chart seems to be supportive of that. I want to go across to the weekly chart and show you a bigger picture story on all of this. Luckily, I kept all of this on my chart just for this video, but if you want to get a copy of this chart and you want to download it, you can go to my Twitter feed, my X feed at ArcisFX. You can download it and put it on your wall or on your fridge or something like that if you want to. But this is where we are at the moment. So we've got this rising channel. I'm going to have to zoom in for a bit. It's going to get a little bit messy. We've got this rising channel. I think this displays it very beautifully. There's that double bottom on the weekly chart. On the daily chart, on the 4-hour chart, it's a triple bottom. But on the weekly chart, we've got a double tweezer bottom. This is a NYMEX Henry Hub weekly chart against that support level. Look at how we traded underneath $2.50 for all this time at the beginning of the year. Then we moved into summer and we're now trading above that $2.50 level. We've made a range shift. We've definitely made a range shift. And unless we break and close beneath on a weekly basis, maybe a daily basis, $2.50, I will continue to believe that we've moved into a new range and we're trading now between $2.50 and $3. And at some stage, we're going to break out of this range and take the next step forward and higher. And believe it or not, the next range is $3 to $3.50, and I'm going to show you why. So we've got 3 discrete separate ranges, 2 to $2.50, $2.50 to $3, which we're in now. Then we've got the $3 to $3.50 level, which is the forthcoming attraction, I believe, as we move in towards the end of this year. Let's have a look at this. So I've drawn some arrows up here. First of all, I said we need a channel break. We still haven't had that channel break, and we haven't broken above $3. It's a really, really important level, as you can see now. This level here, this sort of flesh zone that we fell back to, is a really key level as well. We really don't want to go much below there. We certainly don't want to go below $2.50. I've got this green zone painted in here. It's all going to get a bit messy, but have a look at this green zone, and the green zone is around and about the $3.50 level. Look what happens at $3.50 every time we get there. This is the December 2021 low moving into January 22. It's a swing low at $3.50. You go back a bit further in time, we get to February 2021, it's just about where we reached up on that swing high. Let's zoom in a bit to show you that more clearly. When we go back a little bit further in time, we've got November 2020, it was the swing high. And you'll know now why I use that sort of range, $3.40, 50, 60, or 75. That's kind of this band. Starts at about $3.40, ends at 375. So that's why I keep on mentioning that group of numbers. If we go back further in time, you can see it was a swing high there. Now we're back into 2019. If we go back even further than that into 2018, the swing high there. We can just keep on going back further and further into the past. This $3.40, 50, 60 or 75 level crops up over and over and over again. Let's see how much further we can go back whilst my charts are loading. So here we are into 2014, 2015. You can see it was a support level there. It was a consolidation level in 2013. Support and resistance, and it's already 10 years ago now. We can go back to 2010. It was a support and resistance level time and time again. And we can go back to 2009, and we can go back as far as we want. This level at 340, 50, 60 or 75 crops up over and over and over again. It's a natural price magnet because of all of that, but it's also where a lot of funds are holding and bag holding long positions. As we saw from the COT report, we're seeing short positions being taken off. I think those are the hedge positions. Not so many long positions being added on by large funds, but a lot of short positions being taken off. And I think those long positions that they're still holding, a lot of them are from $3.40, 50, 60 or 75. Now, last thing I want to say on this before we finish off in these pretty pictures, I want to point out to you on the weekly chart, I've shown you on the daily chart before, but on the weekly chart, we're looking at the bigger picture now. What we see here at the top of this $3.40, 50, 60 or 75 level is where the 200-week moving average is, and the 50-week moving average coming down towards it to meet it. That's the top of that range, and I think that's going to be the level where the 50-period moving average and the 200-period moving average on the weekly chart meet, and eventually the price meets up with those two. And when these two moving averages meet, as you can see, this is coming down. It's going to even out and flatten out slightly. You'll see it gets us towards about the end of the year. What's interesting about this 200-period moving average, this purple line, is that it's perfectly parallel at the moment along that $3.75 level. Now I want to show you something very quickly as we finish off, and that's this pink level above us. And let me try and neaten up this chart very quickly. This pink level is centered at around and about $4.50. So somewhere between, actually funnily enough, somewhere between $4.40, 50, 60 and 75. The top of this pink level is at 75, very similar to the 340, 50, 60 or 75 green level that we're aiming for beneath us. But I want to show you why I've drawn this pink level in. You can see it's a swing low from 2022, but it's also, like the green level that we're aiming at, an important recurring support and resistance level over time. You can see there going back into 2018 and 2022, and again over and over and over as we go back into the past. You can see this $4.40, 50, 60 or 75 level is a key level. I'm not going to waste too much time by going back forever on these charts. There's just an example from 2006. I think that might very well be our next target level, $4.40, 50, 60 or 75, as we move into perhaps some sort of event, geopolitical or weather event, supply event, demand event, whatever it might be. It's possible, I'm not saying we're going to, but it's possible that we could be aiming for $1 higher than our current target range of $3.40, 50, 60 or 75, and we could be going into the $4.40, 50, 60 or 75 range as time goes on. There's no reason to expect that we can't get there. I'm not sure if it's going to happen or how long it might take, but it's a possibility. Okay, that's all been a pretty big mouthful, and I hope that made sense to you. Just going back to recap to the shorter term chart, I'll tell you what my positions are one more time. Long from an average of $2.68. I'm going to switch this back to the 4-hour chart. Based on the reversal candle that we saw late on Friday, it's a piercing pattern with a tweezer bottom, well, it's sort of something between a tweezer and a piercing pattern bottom, but it's a definite reversal candle. It's exactly what we were looking for. I pointed out in the previous video and on Twitter. Please go and have a look at that video. I've put a link at the end of this one to that last video so that you can see what I was talking about. Good luck with your trading, and I'll update as the week goes on. Once again, please, if you've enjoyed this video, help me out by just giving it a thumbs up and subscribing to the channel. And your subscription helps me to pay for the information that I have to pay for to bring it to the community. Thanks so much, and good luck for the week opening in a few hours time, and we'll see what happens on the Sunday gap or no gap, spike or no spike. I don't know what's going to happen, but we'll find out pretty soon.